Sector has been the high flyer during the pandemic, but in recent sessions we've had a bit of chop in that trade. A lot of questions being asked about valuations. What will yields mean in the bond market? What will the reopening of the economy mean for this space? Let's bring in Dan Morgan, Vice President, Senior Portfolio Manager at Synovus Trust. And Dan, I want to start there with you because you do get the sense that investors, even on a day-to-day basis, are asking some questions about their tech holdings and just wondering about these valuations, what we're paying up for these stocks.
Well, Greg, I mean, in terms of valuations, I mean, you look at the S&P Information Technology Benchmark, it trades at about 35 times earnings. You compare that to, let's say, the S&P 500 at about 31 to 32 times earnings. So it's not really excessive when you compare it to the broader market. You look back at the tech bubble in summer of 2000, we're trading at 70 times in tech stocks. We're about half that right now. So from a valuation perspective, I think we're in good shape. But I think what we're seeing happening, and we saw this a little bit last week when we had Salesforce and Nvidia report numbers, is that it doesn't really matter what these companies come in with, someone's going to find some fault in it. And even, for example, Salesforce raised guidance, and so did Nvidia. It wasn't good enough. So I think what you're seeing too is money rotating out of the growth area in tech to a certain extent and going into some of these recovery sectors like you were talking about before, hospitality and retail and all these groups that have really been maligned by the pandemic. And I think that's another reason why you've seen this shift in capital.
Now, last week when we saw the bond yield spike, I mean, it was a quick move in a very short period of time. It still left yields in places that were far below what we're used to historically. But that introduced, I guess, a little bit of caution into the trade. And again, it seems that the tech stocks have to take the brunt of that. As you take a look at yields in the market, do you have concerns about them continuation of, I guess, those kind of pressures?
You know, you always think about don't fight the Fed. You always think about the substitution effect, right, Greg? Which is when rates go up, then that makes bonds more attractive. Why risk owning a stock? But even right now, I mean, what, 1.5% on a 10-year? We saw the 30-year get above 2. It's still pretty low from a historical perspective. So I think if we saw the 10-year go back up to where we were before, let's say north of 2%, I think then you start to get some competition for those funds into the bond market. But I still think at 1.5, and of course the short end is all very low because of the Federal Reserve holding the Fed funds rate, we're not quite there where you're going to have a massive substitution effect, money coming out of growth, tech, and going into, let's say, buying bonds. I still think rates are pretty low from a historical perspective.
Right, when it comes to those tech stocks, one area of them that's been quite interesting has been the semiconductors. I mean, chips go into everything now. We're hearing about shortages in terms of automakers trying to get their hands on it. As investors, how should we be thinking about that space?
It's amazing, Greg. You look at chips back in March of 2020, the SOX, the Philadelphia Semiconductor Index, is up about 230% from that low. It's even done better than all the other tech sectors. So it's amazing what has transcribed in the last year. I mean, we've gone from concerns that there'd be a huge glut because of pandemic and demand to shortages, and really the chip sector doing absolutely phenomenally well. I would expect those shortages to probably still be here through probably the second half of 2021, and then they should mitigate as these chip makers start to really up their production. So overall, I think the chip sector is pretty much executing on all cylinders. There's only a few groups like PCs and memory that are still kind of muted, but we're seeing a cyclical upturn in autos and industrials, and of course, broader-based themes in 5G and so forth are doing very well.
Okay, so against that backdrop and for that space, some names that you like in particular, I think we have two on our radar. Let's start with Nvidia.
Yeah, Nvidia is a company that's benefiting from the huge influx, not only in gaming, but in terms of the build out in the data center servers that are used in the cloud area. They reported last week, had really good numbers. They're in the process, Greg, as you've probably reported, of acquiring a company called ARM, which is in the artificial intelligence space. It's kind of a royalty chip manufacturer, kind of like a Qualcomm. There's been some pushback on that, but if you think about Nvidia right now, they're definitely growing at a very fast pace, and they seem to be in all the right markets right now: gaming, artificial intelligence, and data center.
Okay, you like Applied Materials as well.
Well, Applied Materials is kind of interesting because it's a stock that I've been following for almost 30 years. And recently they've made a huge jump in terms of their share price. And one of the reasons it's been is the fact that there's been all these shortages, and a lot of companies in the past were not building out their infrastructure in terms of their capex or building out their fabs because of the pandemic, and all of a sudden you get this big shortage come in, and now all of a sudden they're starting to ramp up. So Applied Materials is a company, if people aren't familiar with it, they're a leader in the actual equipment that goes into building the semiconductors. Companies like TSMC and Intel and so forth all buy equipment from Applied Materials. So when you have a shortage and then you have to build capacity, companies who make the equipment to increase capacity do well. And that's kind of the underlying theme behind Applied Materials.
All right, great breakdown of two chip names. Before I let you go, I did want to ask you about the broader FAANGs and any regulatory risk, political risk, right? Because these names grab headlines because they often butt heads with the politicians, particularly those in Washington.
Yeah, Greg, and a news story came out just today talking about concerns about the monopoly between, let's say, iOS, which is Apple's operating system and the smartphone, and then Android, which is Google's, kind of their 1 and 2 punch on that. Then I noticed that they're requesting how Google files their searches and how they go through their mechanics of coming up with information. So DOJ and FTC very busy after those companies right now. So obviously that's a risk. We'll see if they have to write more checks in future quarters like they've done in the past. But it's definitely something we need to follow.
All right, Dan, it's always great to get your insights. Thanks so much for joining us.
Thanks, Greg.
Dan Morgan, Vice President and Senior Portfolio Manager at Synovus Trust. We're going to